Okay, welcome to Unit 5. This is our second section of notes, but I will break this into two sections. We will talk about initial low risk and medium risk investments. We'll stop at stocks, and then I'll pick up the next section of notes on mutual funds. So you can see in the very front we've got two pictures of our largest exchanges. We have our New York Stock Exchange on the left, and we have our NASDAQ, which is on your right. So what are some investment options? Well, investors can consider what risks they can handle, which then in turn reflects on what kind of return they would have, return on their investment. So low risk investments typically get you low returns, medium risk investments will get you medium returns, and then high risk investments will get you high risk or high rates of return. So when an investment is available to be purchased, it can be purchased on the primary market, and that's when they issue new investments on an exchange, and those are considered initial purchase offerings such as IPOs. So just in the fall of 2013, Twitter was an IPO, and then a couple of years ago, you guys can remember the Facebook became a IPO and has been doing very well in the stock market as well. In the primary market, that is the only time in which the corporation makes money off of the selling of its stocks to shareholders. They sell them to large investment firms that are interested in borrowing large quantities, in which they will then turn around and sell them on the secondary market, which investors like you and I can buy and sell through E-Trade, Dow, and other investment companies. So here's our pyramid of investments. You can see at the bottom is our large amount of low risk, low return investments such as corporate and municipal bonds, government securities, savings certificates of deposits, and money markets. And then you can see in the middle we've got stocks, mutual funds, annuities, and real estate. You have, even though they fall in the medium risk, you've got medium low, medium, and medium high. So you've got stocks that fit into all those categories. You have real estate that fall into all those categories, and mutual funds. So that's not unusual to have still a relatively high risk but fall in the medium category for stocks. And then your high risk investments, which typically happen in the speculative stage of investing, would be your futures, options, penny stocks, and collectibles. So let's talk about our first low risk investment. That's going to be bonds, and that's an IOU from a corporation, a local government, or federal government to raise money. You will receive a face value of a bond for, let's say in this example, $100, but you will purchase it out in the stock market for a lower than market value or face value. So let's say you issue that bond at $90, you hold on to it till the maturity date, and you will then get the face value, so a $10 return on every bond that you hold plus interest. So companies will choose to do bonds if they need to make some huge capital investments, or say a municipality such as Lindbergh School District would issue bonds to do a large capital investment such as the adding on of our pool or the building of Dressel School off of Music Road. The big issue with bonds is that you must hold on to them till maturity date, and that they are relatively low return, but they are very low risk. Those are the first people to be paid back. Bondholders are if the company were to file for bankruptcy, not shareholders. So bondholders are the first ones to be paid back. And examples of medium risk investments are going to be your stocks, mutual funds, annuities, and real estate. Stocks are a representation of ownership of a corporation. Stockholders own a share of the company and are entitled to a share of the profits as well as a vote in how the company is run. How earnings are made is first through the profits divided among shareholders in the form of dividends. So a company at the end of a quarter takes a look at what their projected profits were, and then they take those profits, divide it out with its shareholders, and you receive an income check for those dividends. Another way in which you can make money off of stocks is buying a particular share at a current price, hold on to it for a period of time, and then sell it out on the market to hopefully get an increased value on that stock and then get the difference in that capital gain. The advantages are if the market value goes up, the gain can be considerable, and money is easily accessible. Stocks are liquid. You can sell them out on the stock market, ask your stockbroker to make a sale, and they will send you a check for the capital gain in a relatively short period of time. Disadvantages are if the market value goes down, the loss can be considerable, and selecting and managing stocks often requires study and help of good brokerage firm. So in a bull market, that is a prolonged period of rising stock prices and a general feeling of investor optimism, and you can see the bull horns going up. So when you think of a bull market, horns go up, means stock prices are going up. In a bear market, it's a prolonged period of falling stock prices and a general feeling of investor pessimism. So you can think of bears sleeping during a period of time where the claws bearing down, so downward trends of market prices. So a stockholder is also known as a shareholder, and they're owner of a corporation. If a company has 2 million shares of stock available for people to purchase, the number of shares in which you own divided by the number of shares that are made available would tell you what percent ownership you have of that company. Dividends are the profits that the corporation pays to stockholders. And then once again, that capital gain is the increase in the value of the stock above the price initially paid for it. A blue chip stock is a stock of large, well-established corporations with a solid record of profitability. So these are companies that have been around for a long period of time, such as Coca-Cola, IBM, and Johnson & Johnson. And then a stock split is a direct increase in the amount of outstanding or available stocks by splitting the number of stocks, which in turn has an effect on the price of that stock. So an example would be, say Google choose to do a stock split because its market value is currently too high for its average potential future shareholder. So let's say its stock was trading at $800, they decided to do a stock split. Everyone who owned those shares of stock would now have that stock value at $400, but they would now own twice as many shares of stock. The expectation or the benefit of that is that the lower price of that stock would help drive investors to be able to afford to purchase it now, which then would drive up the value of that stock, which then would increase the capital gain that you would have on it if you were to sell. A dividend reinvestment is using dividends previously earned on stocks to buy more shares. They call that a DRIP, a dividend reinvestment plan, in which you take your dividends and you buy more stocks with them. Market value is the price at which a stock is bought and sold in the marketplace. A common stock is a type of stock that pays variable dividends and gives the holder voting rights. Preferred stock is a stock that pays a fixed dividend and carries no voting rights. And then a growth stock is a stock in a corporation that reinvests their profits into businesses so that it can grow with little or no dividends paid out. Generally long-term investment. They're going to use that to possibly grow retail outlets or increase its capital investment or research and development, or try to gain higher qualified potential individuals working for them. So they hold on to those profits, retain those earnings to put towards those investments. And that will wrap up this first section of investment option notes.